the incoming data that the committee has seen since March that caused it to make these adjustments?
Sure. So first of all, these are individual. This is not a committee forecast. These are just individuals submitting their own personal forecasts, and we don't bless those as a committee. But I think people are looking at the incoming data and having a range of different judgments. If you look at the range, if you look at the central tendency, you'll see that it covers quite a wide range. Those are the medians that you're talking about. I think so. Inflation is projected to have moved up because of what we've seen, particularly from tariffs. And I think if you look at other outside forecasters, you'll see very much the same thing.
And what data are you looking for?
Well, we look at the incoming data on, we look at our own forecast, and we ask ourselves what's likely to happen. Monetary policy has to be forward-looking. A forecast is a prediction of what's going to happen in the future.
Thank you. In its statement, the committee announced that it will continue to monitor the implications of incoming data and adjust the stand of monetary policy as appropriate. Some analysts predict 2 rate cuts by the end of the year are still on the table. Is this a fair and accurate assumption? And what incoming data will the committee need to see to consider these cuts?
So what will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty. I mean, we will, the story has been evolving, and our thinking has been adapting, and that will continue.
Thank you. Chair Powell, although a ceasefire has been tentatively reached in the Middle East, the situation still has the potential to open global and energy markets, especially if the ceasefire is broken, while at this point Iran is seen as unlikely to close the Strait of Hormuz. That decision could change. How is the Fed assessing the current situation and incorporating those assessments as it considers future adjustment to economic projections and its stand on monetary policy?
So I think it's too early to know what any economic implications might be, and I would not want to speculate. Like everyone else, we are, of course, watching the situation.
Thank you. And Chair Powell, after reviewing the economic data following the meeting last week, it seems to me that the committee is indicating that we could be headed for a situation where inflation accelerates while unemployment rises and growth become more sluggish. In this scenario, this will put the Fed's dual mandate of maximum employment and price stability in tension with one another. In this scenario, how does the Fed balance these priorities in order to achieve both mandates?
So let me say that we're not facing that right now, and that isn't really our forecast that we will face such an issue in a serious way. But if that does happen, then what we do is we look at the 2 goals and we see which one of them is farther from its goal. 2 variables, is maximum employment or price stability farther from its goal, and we prefer the one that's farther than its goal. And then we also ask ourselves, how quickly will they return to goal? It's a very difficult situation for any central bank, and I would say again, we're not in that situation right now.
Thank you, Mr. Chairman. Yield back.
The gentleman's time has expired. The Vice Chairman of the full committee, Mr. Heising of Michigan, is recognized for 5 minutes.
Thank you, Chair Hill and Chair Powell. Good to see you again. I got a lot to cover, so we're going to try and keep this concise. But following up a bit on what Chair Hill had been talking about, You had said in January 29, 2025, quote, "We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy." I would add energy into that, by the way. "We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. This is no different than any set of policy changes at the beginning of the administration." However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred with the chair to say, okay, did I hear this correctly, his question and sort of your answer? What I heard is that there was a belief that the IRA would not be inflationary, but that tariffs could be, therefore, suddenly you and others were commenting on tariffs. And for the institution, I know you try to be consensus-driven. Why are there FOMC participants making fiscal policy assumptions into their forecasting when you yourself said that fiscal policies need to be articulated before the FOMC can make a plausible assessment into their implications, what those will be? And I think if there's different participants having different assumptions, that would render the SEP, Summary of Economic Projections, biased, meaningless, useless, less impactful, and when you're not comparing apples to apples. So wouldn't it make more sense for all the forecasters to make the same fiscal policy assumptions at the same time? Or if not, shouldn't each participant disclose what assumptions that they're using and building into that? So here's the question.
So that's a great question. That really, when the Summary of Economic Projections was originally designed and put into effect in this way, the way it works is that individuals are free to make whatever assumptions they want, and they do disclose them. They disclose them in their speeches and things like that. So there will be situations where some people incorporate something and others don't, and we try to be transparent about that. But that's kind of the way it works. When I say we don't take it into account, I'm really talking about policy and the committee as a whole, where we won't take things into account until we know.
And you believe that the participants disclose their assumptions when they're doing their forecasts?
Well, I think they do that in their speeches. Each people go out. You may have noticed there are a lot of speeches.
Well, I guess the opaqueness of the Fed has been something over the arc of my 15 years on this committee, has been one that has been debated greatly, including auditing the Fed and a number of other things that have gone on. I've got here a brief moment. I do feel like I need to touch on interest rates. Not to be a shock, you asked how the family business was doing back in Michigan. Families involved in sand and gravel and aggregates and construction and things like that. It's been strong. We need more labor. We need a few other things on that, what's happening. But I mean, I think there's no recession. That's been established. There's no hyperinflation, or certainly not as what some had been projecting. Yet there seems to be higher than expected, or certainly desired interest rates for many of us. And I'm curious how high interest rates, they hurt Americans who are paying car loans, credit cards, mortgages. You had FHFA Director Pulte asking for lower interest rates, which would obviously impact home buyers as well. So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates, and by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks, by the way, that's your own assessment on page 33, as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariffs concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why? So
you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that would call for us to be at a neutral level, which would be, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know a lot
Gentleman's
more.
time
It's
has
6
expired.
months since I said that. So anyway, I'd be happy to continue this with you.
Thank you.
Gentleman's time has expired. Gentleman from Michigan, Ms. Tlaib is recognized for 5 minutes.
Thank you so much, Mr. Chairman. Chair Powell, last month there was research published in the Journal of Urban Health that found that more than half of Black women of reproductive age, that's the term they use, in the counties that I represent, that had experienced some sort of eviction during their lifetime. So that's like 50% of Black women in the two largest county, Wayne County and Oakland County in Michigan. And these numbers are horrific. As you know, were you aware of that?
No, I was not.
And you know, evictions are often very traumatic experience, but also it creates a cycle of poverty, but also this instability for many families. But especially when it comes to a lot of our Black neighbors, the access to equity, the access to housing is diminished even more. In Michigan, we lost more Black home ownership than any other state in the country during the last recession. So we know the housing crisis, I believe, is structural, and some may say it's a policy choice. While there are many factors at play, and you know this, Chairman, high mortgage rates, the finance rates and so forth, that drag the supply of new housing. But last month, new housing hit a 5-year low. Are you familiar with that?
I'm not sure exactly what statistic you are referring to.
Okay, I don't know. There was all this articles about the housing market and the impact of tariffs and so forth, and they said, again, it hit a 5-year low. And again, I'm getting this from a source. But this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, you know, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect.
Well,
there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute best thing, is to restore price stability so that rates come down and so that rates can be at a level that people can afford.
But don't you think that the restrictive monetary policy the framework you all put together undermines long-term price stability right now by reducing the supply?
No, I mean, I think
But you're reducing
restores
supply.
price stability. The point of higher rates is to,
So you don't think the higher rates is impacting future supply of housing?
So I think what that does is, I think interest-sensitive sectors like housing are very much directly affected when we cut rates or when we raise rates. That's right. But that's part of the mechanism for restoring general price stability.
So keeping the high interest rates does not impact future supply of housing?
It does not, you know, over the long...
I need to go back to talk to
over the long
women
run,
that the
Fed will not be, our policy will not be a driver of longer run housing supply in the United States.
Okay, let me ask you, what is the difference? And honestly, confused. I want to learn here, and I'm sure people listening to this want to learn. What is the difference between demand-driven rent inflation and supply-driven rent inflation? Like, you guys use these terminology. What is that? How do I communicate that to the public? What is the difference between supply-driven versus demand-driven rent?
You know, those are not terms that we use particularly often.
What's supply-driven formula?
That would mean that, you know, that there's not enough supply to meet demand, but at the same time, it also means there's more demand than there is supply.
So are you guys ignoring that?
No, but as I said again, our policies will not affect in the long run.
No, I'm being
either
serious,
demand
'cause I
or
see somebody
supply
behind
in
you kind of
housing.
I'm being serious, y'all. We're talking about a housing crisis that is getting worse right now because we're not paying attention to future instability that the current rates, and you can raise your eyebrows and all this stuff behind. I don't know. I mean, do you understand? Like, I come from a community right now that I believe is now being impacted by the current framework that you're putting together, that I do feel like is going to be long-term effects on the housing crisis, and you're ignoring it.
No, we're not, actually. We think the very best thing we can do is to fully restore price stability at the aggregate level. That will be the best thing for homeowners and for home
Even though the
builders and
housing
everybody
supply
else.
has been
In the
impacted by
long
the high
run, that
interest-
is the single
But
thing
Chairman
that
Powell,
Congress
you
has
see where I'm
assigned us
coming
to
from.
do.
But you see where I'm coming from. It is impacting future supply of housing, right?
Not in the long run, no.
Okay, well,
Gentlewoman's
Mr.
time
Chair,
has
thank you.
expired. The gentleman from Wisconsin, Mr. Stile, who's also the chair of our subcommittee on digital assets, financial technology, and artificial intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed the reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing, and over the course of really 2024, came to the view that this was a serious problem that we need to address, and we've said that publicly, and now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space if I can. Another action recently taken by the Fed, the Novel Activities Supervision Program was ended and withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others, the Fed, have spoken positively about the House and Senate work to regulate stablecoin in particular, a real opportunity to dollarize the globe and be a significant purchaser of U.S. Treasuries. Following that action by the Fed, have you seen an identifiable shift in banks or other regulated entities as it relates to engagement in the digital asset space?
You know, I wouldn't be the one to be picking that up first, but what I do see is a very significant change in the tone, and it really does reflect evolving thinking and the evolving status of the crypto industry. And I would expect over time we'll see more activity.
How is the Fed evaluating and overseeing banks or other regulated entities that are in the digital assets or crypto space?
So our view is that banks get to decide who their customers are. That's not our decision. And so banks are free to provide banking services to the crypto industry, to crypto companies, and banks are also free to conduct crypto activities as long as they do so in a way that is protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability. But also higher rates have a significant impact on the housing market, as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Could you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.
Gentleman yields back. Gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Chairman, thank you for your testimony today. I appreciate that your dual mandate is full employment and price stability, and I appreciate your efforts on behalf of our country to achieve those. My understanding is that critical data is collected by the Bureau of Labor Statistics to help formulate the indicators that you rely on, that we rely on to understand unemployment rates, CPI, and other inflation indicators. We are certainly hearing a lot about the impacts of DOGE on our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million from that agency. Are you concerned about the ability of your team to get accurate data and about the ability to have reliable indicators to make good decisions upon?
I wouldn't say that I'm concerned about the data today, although clearly there has been a very mild degradation of the scope of the surveys and things like that. But I would say the direction of travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening? Is growth high? Is it low? And all those sorts of things. So I think it's a smart investment to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, the kind of stories I'm reading and the idea being that the data is going to become more volatile and less reliable. That'll make it more difficult for the private sector and for you and for us, and I don't like to see that direction.
I agree, thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through a distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
That very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility, and that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, there's indications in the introduction of the report that the Fed is losing its ability as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time, and I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So first of all, the inflation and employment readings were very similar then to what they are now. They weren't terribly different, a tenth or two.
Right.
But the difference then was, you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era, in which the unemployment rate has gone up close to 1% that hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely a very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So it was all about the labor market. Inflation was the same, and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September, and it seemed like the right thing to do. And at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? So
I didn't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about, did the Fed do the right thing or not? I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already, you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and we can't just ignore that, but we're not. We're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. You know, we're going to continue to adapt as the data adapt. But that is the difference between then and now. Then, inflation was forecasted to continue to come down. Here, it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, you know, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
What about supply chain? In 2020, that